Hello everybody, this is Joe from PrepAgent. Give me a thumbs up if you can hear me, and we'll get started with the webinar. Let's hear what state you're from. Andrew Hardy's from Tarzana, California. Good to know. Carol Potter from Knoxville, Tennessee, home of the Vols. Okay, so you guys can hear me? I sound good? Hello, Ray. Looks like Ray's got a bow tie in his profile picture. Always takes a lot of confidence to pull that off. Good for you. So it looks like we're all good to go. So we're going to get started with the finance. Okay, so if you guys notice, I just did a video on finding a broker. Check that out. Okay, check out that link on finding a broker. I did a little short video before this webinar. And what else I would like you guys to note, some of you guys write me messages through Instagram and Facebook, which is great. But I gotta tell you, that's not our primary source to get to messages. So I apologize if we don't respond to you there. The best way to contact us is through the website. We have a system of making sure everything through the website is checked. It's very difficult for us to check all the social media outlets regularly, like Instagram, Facebook, LinkedIn, Twitter, Pinterest, because we're on all of those. So it's just not realistic to check that. So we try and tell everybody the best way to get in touch with us is to go directly through the website, all right? So if I haven't gotten back to you in any of those realms, I apologize, and I'll try and do better with that. Okay, so we're talking about finance. So in talking about finance, who could tell me what the primary market is and the secondary market? What is the difference in the primary market and the secondary market? Thank you, Sarah. What is the difference in the primary market and the secondary market? Okay, so secondary market is the resale marketplace. Good. So what's the primary market? David Julia Rosenberg cannot respond. I can only listen. I'm driving, love learning. Well, I hope you're not typing that while driving. Okay, so the primary mortgage market is where you go up to the bank, you get a loan. Okay. The secondary market is where loans are resold. A lot of you guys remember resale marketplace. So what does that actually mean, resale marketplace? Or is that just some super fancy word you learned because, you got to pass the exam? So basically the idea of the secondary market is that the banks could sell off those loans so they have more capital to lend out to other people. And then people in the secondary market make that money off the long-term interest and things of that nature via the stock market and other things like that. Okay, so without the secondary market, the banks would run out of money to lend out. Everybody get that? Okay, good. All right. Let's do a question from the board. Most lenders, when they're deciding whether or not to make a proposed real estate loan, try to minimize the A, chance of a substandard loan becoming a part of their portfolio, B, loan to value ratio, C, the borrower's difficulties which may arise in the future, such as a divorce or death, or D, overall net yield. Okay, moving right along, and the answer here is A, chance of substandard loan becoming part of their portfolio. All right. They don't want. What are substandard loans? Who knows what that is? Looks like some of you got this one wrong. So what is a substandard loan? What do you guys think? So substandard loan would be one that's a high risk, right, guys? That would be a high risk. You got to remember, lenders try and minimize risk. They do not love the idea of risk, okay? When a lender lends you money, what do they do to make sure you're not a big risk? What do you guys think? What do they do to make sure that you are not a big risk? What do you guys think? So they do a credit check. Good. They check that FICO score. Excellent. They do a background check. They check if you have a job, right? That's that your income. What's the most important thing, though, they do when they check the risk? What do you guys think? What's the most important thing? What do you guys think is the most important thing? You guys haven't named the most important thing. Well, Erica kind of did. The value of the property. Nice job, Martina Cole. When you guys said loan to value, I think that's what you were getting at. So you guys who said that, you are correct as well. The most important thing is the property itself. Why is the property itself the most important thing when they make you a loan? What do you guys think? Why is the property itself the most important thing when they make a loan to you? Why is that more important than your income or your credit? What do you guys think? Who can answer that one? Nice job, Pat T. All right, because that's the collateral. It's the collateral. If you do not pay off that loan, they need to be able to sell your property to get the money back. That's why it's so much more important than your income or your credit, okay? Because that's the thing they use. That's why usually they want the value to be at least 20% above the loan amount. And if it's below that, then you're going to have to pay more money than if it was above that. Knows how to party. Okay, here we go. Jones owns 3 pieces of real estate: a house, a lakeside cottage, and a tract of woodland. Which of the following expenses may be deducted for all 3 properties on the Jones income tax return? A, both mortgage interest and property taxes. B, property taxes. C, mortgage interest. Or D, insurance premiums. What do you guys think? And the answer is B, property taxes. Property taxes, good. By the way, we are super close to 100,000 subscribers. So you're going to see me doing a lot of videos in the next month to try and get us over that hump, because then I get a pretty plaque with my name on it from YouTube, and I want that. So expect a lot of videos coming your way on YouTube from us. We're not there yet. Don't congratulate me yet. I think we're at what, 92,000 right now, maybe 93. Who would have thought? Okay, when making a loan, amortization tables are used in order to determine the A, monthly payments, B, APR, C, term of the loan, or D, interest rate. And the answer is A, monthly payment. Robin Zima says, what is a secondary loan? She wrote that all in capitals, so I believe she's yelling at me. No reason to yell. All right, but I'll answer it anyway. I know you probably didn't mean to. I was writing capitals. Anybody ever text you in capital letters, and then you're just like, whoa, relax, calm down. Jeez, take a pill. Oof. Okay, so a secondary loan. So we have the secondary market, which went over, and a second loan. Okay, so a second loan is another loan that will be at a higher interest rate because it's a higher risk. It's meant to supplement that first loan because you can't get enough money from the first loan. There's many different reasons you would do that, but the important thing to know is that second loan will be in a lower position, therefore it's a higher risk and it would have a higher interest rate. Okay, when an eligible veteran is negotiating to purchase a home with a VA guaranteed loan, as part of the loan process, the VA will issue a certificate of reasonable value, B, certificate of indebtedness, C, certificate of discount, D, uniform residential appraisal report. What do you guys think? The answer is certificate of reasonable value. Who could tell me some facts about a VA loan? What are some facts that you learned when studying for your real estate exam about a VA loan? Ain't nothing but a What do you guys think? David Julia Rosenberg is a vet. Well, thank you for your service. We appreciate that. So please be careful when you're driving and texting at the same time, or driving and watching a webinar and writing things on our chat. We want you to be safe. Okay, so a VA loan has no down payment. Okay, no down payment needed. As opposed to FHA loan would need a down payment. Can you buy a commercial property with a VA loan? Can you buy a commercial property with a VA loan? No. No. What can you guys tell me about an FHA loan? What is an FHA loan? What do you guys think? What is an FHA loan? Alex there says, how much of the loan is guaranteed? Not yelling, thank you. Alex, I gotta admit, I don't know that one. So send us a message to the post that question on our Facebook group, and we'll see if we can answer that, because I don't know the answer to that. If anybody knows the answer to that, then post it. But definitely want to post in the Facebook group, and we'll see what we could get through there. Okay, FHA loan needs a small down payment. Good. All right, and it insures the lender. It insures the lender. Okay, let's look at the question on the board. If a single parent is applying for a real estate loan, when would the fact have to be revealed that part of the parent's income is from child support? A, this type of income never needs to be disclosed. It would be a violation of the Equal Credit Opportunity Act. B, if more than 50% of the parent's income is from non-wage sources. C, if the parent was relying on the income for repayment of the loan. Or D, when applying for a VA or FHA loan, if the parent's income is less than $25,000. And the answer is C, if the parent was relying on that income for repayment of the loan. You guys are going to learn a lot of personal stuff about people when you work with them as your clients. Keep that stuff secret. You don't want to be that guy or that girl or gal. Okay, next question. A lender is required under Truth in Lending Act to furnish an applicant for a real estate loan with a copy of an A. Disclosure statement, B. Financial statement, C. Amortization schedule, or D. A deed. And the answer is A. Disclosure statement. The Federal National Mortgagization was created under Title II for the National Federal Housing Act and is primarily for the purpose of A. Advancing funds to mass production builders in or near large cities. B. Lending money on FHA Title II loans where banks will not. C. Supervising the lending agency associations. Or D. Buying Title II loans to keep the market liquid. And the answer is D. Buying Title II loans to keep the market liquid. Finance is awful. We got to get through it, right? It's my worst chapter. I hate it. But we got to do it. It's part of our passing, right? Stay strong, stay focused, get it done. 3 business days before the closing of a real estate loan transaction, a mortgage loan originator must provide the borrower with a closing disclosure. This disclosure is keeping with which of the following? A. Fair Housing Act. B. Truth in Lending Act. C. RESPA Integrated Disclosure. Or D. Equal Credit Opportunity Act. And the answer is C. RESPA Integrated Disclosure, TRID. Somebody asked if we do math questions. We tend not to on the webinar because these webinars are intended to go over material that applies to everybody, no matter what state you're in. And math is not asked about in every state. Not all the state exams ask about math. Instead, in these webinars, we tend to focus on things that applies to everybody. What do you guys think of this thumbs down icon in the top? We got a complaint that it was making somebody sad and they were going to complain about us to somebody or something because the thumbs down was insulting to them and made them sad. All right, here we go. Who is the California exam does not have math? Who is the largest purchaser in this secondary market? A. Freddie Mac. B. FHA, C. Ginnie Mae, or D. Fannie Mae? What do you guys think? And the answer is D. Fannie Mae. Fannie Mae. Good. So Matt says, why are they showing all incorrect? Matt, that's because I'm not clicking on the answer. I'm just clicking on next question or check the answer at the bottom. I'm not actually clicking on one of the options. I'm just clicking on check answer. That's why they're showing incorrect, because I'm not clicking on the correct answer. Okay, here we go. David sold his home and agreed to take back a note and trust deed as part of the purchase price. He wanted to have the note become due and payable if the property is resold. To accomplish this, which of the following clauses should be in the note or trust deed? A, substitution clause, B, alienation clause, C, subordination clause, or D, defiance clause? What do you guys think? And the answer is B, alienation clause. You guys are doing great. Should have a big PrepAgent party for everybody who's participated in a webinar before. Have the party in like somewhere cool. Like on some island in the Caribbean where the beaches are pretty. All right, here we go. When the deed in which you take title to a property contains the following clause, subject to the existing loan. Yes, Chicago. That's what I meant by a Caribbean island with pretty beaches. You got it, Stella. I'll be there. Chicago. Okay, the seller is permanently relieved of the liability. B, you are in danger of losing the property if the seller does not make the payments on the underlying loan. C, you agreed to assume the loan and make the payments directly to the lender. Or D, the lender is guaranteed that you will pay off the loan. What do you guys think? Okay, you are in danger of losing the property if the seller does not make payments to underlying loan. So you guys hear this term, assume and subject to. Assume and subject to. Okay? What is the difference between assume and subject to? What do you guys think? Assume and subject to. And this one I want you guys to remember. Everybody write this down. Subject to, seller liable, assume buyer liable. Everybody write that down, please. Subject to, seller liable, assume buyer liable. All right? Subject to, seller liable, assume buyer liable. And what that means is if it's subject to, that means the seller is liable for any debt when the transaction takes place. Where if it's assumed, the buyer will take on that debt. They will assume responsibility. An adjustable rate mortgage would be a good choice for all the following except A, a buyer who has a large down payment but needs a smaller monthly payment. B, anyone on fixed income. C, borrowers whose income will be increasing. Or D, a buyer who plans to live in the property under 6 years. What do you guys think? And the answer is B, anyone on fixed income. Good. What is amortization? What do you guys think is amortization? What does amortization mean? What is amortization? So amortization is the process of paying off your debt. What is negative amortization? What do you guys think? What is negative amortization? What is negative amortization? So negative amortization would be your debt goes up because your payments do not cover the interest. Andrea mentioned a balloon payment, and that's important to know when you're discussing a partially amortized loan. A partially amortized loan. And that means you're making your payments, but then you make one big payment and it's all paid off. And a straight note, what is that? What is a straight note? What do you guys think a straight note is? A straight note. So a straight note is when your payments only cover the interest, so your debt goes straight across. It doesn't change. That would be a straight note. Good job, everybody. Okay, let's do the question on the board. Jones has a mortgage payment plan that allows him to pay less than what is actually required to cover the debt and interest on it. He is in danger of A, conversion of their mortgage, B, negative amortization, C, equity sharing, or D, graduated payments. What do you guys think? The answer is B, negative amortization. We just went over that. I'd totally cry if you guys got that wrong. Don't you cry tonight. Where's my Children of the 90s? A little Guns N' Roses action there for you. Don't you cry. Ooh. Okay, here we go. Truth in lending laws are applicable to A, residential real estate mortgages, B, all personal property transactions, C, land contracts, D, commercial transactions involving real property. Anybody who went to high school in the 90s, you're automatically like a depressed person. All that Pearl Jam, Nirvana, Guns N' Roses. All the music was like, yeah, I'm so bummed, yeah, depressed, lame, wear crappy clothes, yuck. Okay, here we go. True lending laws applicable to A, residential real estate mortgages. Residential real estate mortgages. The grunge era, they should just call it like the boycotting of deodorant era. Okay. Truth in lending laws applies to residential. Understand these laws are there to protect you against people when buying residential homes. A lot of these laws do not apply to commercial real estate. (1996) when it was cool to stink. Okay, the clause in a mortgage contract or trustee which allows the lender to call the entire unpaid balance due upon default is called the A, cancellation clause, B, balloon payment clause, C, defines clause, or D, acceleration clause. And the answer is D, acceleration clause. Acceleration clause. Okay, they accelerate the loan. Usually if the property's not being taken care of, like if you're not paying taxes or you let it go bad. Remember we discussed how that property is the collateral for the loan. So if you do anything to jeopardize it, you'll be in big trouble and the lender could call the loan. Okay, moving right along. When obtaining a mortgage loan, the buyer often has to pay discount points. Those points are a percentage of A, the selling price minus the agent's commission, B, the selling price of the property, C, the loan amount, or D, the loan amount plus closing costs. And the answer is loan amount. Very often on your exam, they'll make this look like a math question, but it's really not. They'll give you a number and they'll say, what is the amount of points or how much is it? Just got to remember, a point is a percentage of a loan amount. So, for example, if it's a $100,000 loan, 1 point would be $1,000 and so on. Okay, so just remember, a point is a percentage of the loan amount. Everybody got it, right? Got it. If a borrower takes out a mortgage that requires monthly payments of $875.70 for 20 years and a final payment of $24,000.95, this is what type of loan? A, an accelerated loan, B, a variable, C, wraparound, or D, balloon. Okay, we talked about this before. This would be that balloon. It's one big payment at the end that pays off the entire debt. Good job, everybody. How many of you guys feel like you know me? Doesn't it feel like we're like buddies? Okay, move right along. All right. I once went to Starbucks and I ordered my drink and I was really excited about it. And I was talking to the barista about my drink. And then this person was like looking at me and she was super attractive and I was excited. And she was looking at me and I was like, oh, it must be because I'm wearing a blue shirt. My blue shirt does look nice on me. And then she came walking up to me. I got really nervous. And then she's like, oh my God, you're Joe from PrepAgent. I recognize your voice. I just passed my real estate exam. I was like, ugh, lame. She's not interested in me at all. She just recognized my voice from the webinars. I showed a lot of appreciation and gratitude, of course, but deep down, I was kind of bummed. Okay, here we go. A loan made with real estate as security and not involving government participation in the form of ensuring guaranteed or direct lending is known as a conventional loan, B, Bancroft bond, C, budget mortgage, or D, standby loan. Okay, so it's a conventional loan. Good. Non-conventional loans are ones that are backed up by government institutions. Conventional loans are just standard loan. You go to the bank, you get it, and you're good to go. Mortgage bankers typically, A, do not finance construction loans, B, originate a large number of loan transactions and then sell mortgages at a discount to large investors in the secondary market, C, are the ultimate lenders in the most non-governmental loan transactions, D, will not act without the consent of the principals. Okay. And the answer is B, originate a large number of loans and then sells the mortgages at a discount to large investors in the secondary market. Okay, moving right along. We went over this before. On an FHA loan, which of the following would the buyer not be required to do? A, make a 20% down payment on the loan. B, provide mortgage insurance to protect the lender. C, make FHA credit standards. Or D, find an approved lender willing to make the loan. Okay, answer was A, make a 20% down to the down payment on the loan. Okay, ready? Remember, the FHA loan only needs like a 3.5% down payment. A loan that provides for increase and decrease in interest rate during its term is known as an A, adjustable rate mortgage, B, equity sharing, C, reverse annuity loan, or D, graduated payment loan. The answer is A, adjustable rate mortgage. Good job, everybody. So tomorrow I'll be back at 9 a.m. Pacific time, 12 o'clock East Coast time. We have our Friday webinar. It'll be good for the weekend. Thank you, everybody, for attending. For those of you guys who are wondering what happened with that person at Starbucks, she came up to me and she was like, "Oh my God, passed my real estate exam from your webinar. So great." I was like, "So you like this webinar?" She's like, "Yeah." "You're happy?" "Yeah." "You like what I do?" She's like, "Yeah." And I said, "So you're really excited to start a real estate career?" "Yeah." "And you give me credit?" "Yeah." I said, "Okay, so do you want to get lunch?" And she's like, "Absolutely not. No way. No way." I was like, "Oh, thought I had something going there." But nope, it did not result in anything. So, guys, I will see you guys tomorrow at Friday. Good night. Buenos noches. Mañana.